All right. Welcome, everybody. Um, our Facebook live stream is not working because Facebook is this rinky dink company that is just a startup. They don't even know what they're doing. I don't know what's going on, actually. but we'll get it rolling anyways because I don't care. I'll record it and we'll upload it that way. So thanks for being on. And let me share my screen here. All right. Share screen. There we go. All right. Hopefully that looks all pretty. So I'll start off and I'll say that we've been hosting these calls. I've been hosting these calls over the last few weeks, and the feedback that we've been getting has been really, really cool about what people want to hear about. And if you are hearing this, hopefully you're within our target audience. Anyone can benefit and take away small tidbits from what we're sharing, but it's mostly directed at sales professionals. And the reason why, not only because I happen to fall in that category, but at the same time, most, if not all, sales professionals have control of their income. And that's a big factor when we talk about where to put money, because there are some people out there, and if you're hearing this and listening going, hey, I don't have control of my income. I've only got, X amount coming in, and here are my bills, and I can't do much to change it. I don't know how you can get to have more money. That may be not my spot to tell you how to make more money. But with sales professionals, they do have control of their income. And what we've found, and what you probably know, is that sales professionals, whether you're in real estate or you work for tree trimming equipment, it doesn't matter what you do, you're really good at selling. But what we've found is that most, and why our company exists, is what we found is most sales professionals don't have good grips on their own financials. A lot of times they're feeling fuzzy. They're not sure about ratios. They're not sure about metrics. They're really good at selling. And essentially what it comes down to is they want to be running a business, but they never feel like a business owner. And that's why we provide these calls. And this is why we provide our services, so that sales professionals can have a feeling of a lot less anxiety and a lot more control. And that's something that we provide to our clients. So I want to start off by talking about the wealth building journey with a simple quote. And it's a Dave Ramsey quote. If anyone's heard of him, he's a big financial dude. Financial or building wealth is a marathon, not a sprint. Discipline is the key ingredient. It is pretty rare, unless you win the lottery, that you're going to become a millionaire overnight. A lot of times, and almost every case that I've seen, it is a marathon. It's not a sprint. So what we're going to go through today is a little bit financial mindset, setting some financial goals. The big chunk of what we'll talk about, and the thing that most people don't know a lot about, is the order of investing, how to pay less tax with those orders of investments, and then spending less, and how to pay off debt, the correct way to look at the debt that you do have. So let's start off with a mindset. All right. And this is an evolution that myself and almost everyone, unless you were born into money, right, it has taken this approach. And it starts with survival. You have thoughts like, you're thinking about which bills you can delay paying. All right. Robbing Peter to pay Paul, right? You do a balance transfer on a credit card to pay off another credit card. And then you have that revolving cycle. And then it starts to evolve into, I'm going to pay my bills on time. And that's like the first step to get out of the survival mode and into stability. Okay. And stability is where, yes, you're paying bills on time and you're starting to build up some cash reserves. Maybe you make your first big purchase in that you buy a car. You're actually starting to save for taxes. And again, this is directed at a sales professional, right? I remember my first year of being a 1099. I didn't know I had to save for taxes, had all this money coming in, never knowing where it was supposed to go. It was all gone when the time came for taxes. So when you reach that stability, you're starting to save for taxes. And if you're a small business owner, you reach the question in your business where you're working so hard to provide this financial stability, where you start asking a question that's really, really important. And that's, can I afford to hire someone, right? And then when you go from stability, this is the biggest step up, is stability to success, right? So because you have someone, you can afford to hire someone, your organization is most likely growing. And so on the personal side and the business side, you're paying off high interest debt. You may make your first really big purchase, like buying a home or buying multiple homes or buying property, and you're building up really big cash reserves. And then comes into contributing to retirement accounts, which is what we're going to talk about in just a couple of slides. And that's where you get to significance. And this is where we're talking about the top 10% of income earners in the United States. The top 10% of income earners in the US right now are right around 120 grand a year. And they're paying off low interest rate debt, and they're creating a giving plan. I think this is a thing that a lot of people overlook, is creating a giving plan, because when you have a significance where you can change others' lives because of where your money can go, it feels more significant, but at the same time, your money's not just being spent on selfish things. And then you start thinking about leaving a legacy, which is where we start talking about really long-term retirement accounts that set up your children and your children's children for some long-term success. So I want everyone to pause and ask a question. If I keep doing what I'm doing, will I get where I want to get? And if it's yes, hey, that's great. Maybe you can pull a couple tidbits out of here that's helpful to your specific scenario. But for the most people on here that listen and hear that and ask that question to themselves of, if I keep doing what I'm doing, will I get where I want to get? And they keep answering no. Here's the solution. And I'm going to dumb it down. And some of you are going to go, well, that's not what I came here for. But I really have to break this down for you, because there's really only two ways to have more money to get what you want. One is spend less and save more. Okay. So sometimes that just means you're introspective with your personal and professional finances, and you look at them and you see, hey, are there places where I can be spending less and saving more? The other thing, and again, why this is directed at sales professionals, is make more money. Make more money and don't spend more money, right? That's I think instead of make more and save more, the trap that a lot of sales professionals fall into is make more money, but then they spend more money. Because they're making more money, they feel entitled and enabled to spend more money instead of saving more. And of course, the big three is just making more and spending less, right? Growing that gap from income to bills to be a very big gap. And that's the combination of 1 and 2. So where does your money go? Okay, your money goes to 4 places. Taxes, right? We have a joke that the IRS, when you combine those 2 words, it spells theirs. The IRS will always get theirs. So your money goes to taxes. Your money goes to things you want to spend money on. Your money also goes to investments, and your money can go to giving. Now, those first 2, everybody falls in those first 2. We're going to talk a little bit more about the invest side more than anything today, and a little bit on saving money on taxes. So this guy, I hear he's pretty significant. Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And of course, that is Albert Einstein. So let's talk about this. Oh, I gave it away. But there is only one. I was going to quiz everybody here. There's only one type of investment where the money is tax deductible or pre-tax on the way in, and the growth on your investment grows tax-free. There is only one account that exists like that. Don't let anyone tell you otherwise. There is only one account that exists like that, and that is an HSA. It stands for a health savings account. I'm going to give you the brief summation of these accounts, and you can ask questions later on if you'd like, but the contribution limit for 2020, and you may want to jot this down, is $3,550. Now, in order to contribute to this account, there are a couple stipulations, and my rule of thumb is if you ever see stipulations on investing accounts, they're usually pretty good at investing accounts. So first off, a pretty low cap when we talk about an investment. $3,550, not a lot. By the way, if you're over 55, you can do what's called a catch-up contribution of an extra $1,000, and you can contribute $4,550. What a health savings account is it's just like any other investment account in that your money grows however you direct it. However, when you take the money out, you can only use the money for a medical expense. Okay. You can only use the money for medical expense. Now, the amounts of ranges of medical expenses are very great. Like, for example, I'm about to use what I have left from when I had an HSA to pay for my LASIK surgery. So technically it's a medical expense. I'm able to use some of that. So that's the one big thing, is that when you take the money out, it can only be used for medical expenses. Now, the other really important thing to understand here is, in order to be eligible for a health savings account or an HSA, you have to have what's called a high deductible health plan, or an HDHP, high deductible health plan. So when you go to sign up for health insurance, you should know that you are looking for something very specific in order to afford this. So what does that mean? That means your medical plan, your health insurance plan, is probably going to be a really, really low monthly premium. But if anything ever happened to you and you needed to use your insurance, that deductible is going to be very high. Hence the name high deductible health plan. So for those of you that are like, oh, I have a medical history, probably would think twice about investing into a high deductible health plan. But if you're young and you're healthy and you want to invest in one, awesome. All right. Because it's not costing you much on a monthly basis, and you technically still have health insurance, and you can contribute $3,500 a year to your health savings account. All right. Second order of investing, which I'm sure, and by the way, I want to say that this is just our opinion, what we hold true to our core values as a independent. Like, we are by no means like life insurance. We have no skin in the game here. This is just the order of investing that we feel are best. There may be other people with different opinions, and that's totally fine. This is just what we consider to be the best way to order your investments. And I'm sure all of you have heard of this next one. It's called a Roth IRA. Okay. And again, there are limits on a Roth IRA. First of all, you have to earn, your adjusted gross income must be under $124,000 in 2020. Or if you're married, it has to be under $196,000. And remember, that's your AGI, your adjusted gross income. So after all your different write-offs and everything like that, your AGI has to fall under that in order to fully fund your Roth IRA. There is a phase-out number, but that number that you can contribute in 2020 is $6,000. And again, if you're over 50, you can do a catch-up contribution of an extra $1,000. Now, why is a Roth IRA what we suggest as the second order? Because all that growth is tax-free growth. So what this is when you put that $6,000 in, that is after you have paid your income tax. So it's just like if you were to go buy a TV at Best Buy and you decided to spend $2,000 on it, you probably had to earn $2,500 in order to see that $2,000 in your personal account to buy that TV. Well, instead, you probably had to earn around $7,000-8,000 in order to afford $6,000 to dump into the Roth IRA. So when you hear it's taxed on the way in, it's not like you receive an extra bill for contributing $6,000. It's just that with your post-tax income, you decided to put $6,000 in a Roth IRA. But as the money grows, you do not pay any taxation on the growth, which is phenomenal. Two other quick things about a Roth IRA. In order to pull it out penalty-free, you have to be 59 and a half. So when you're 59 and a half, you can pull out all the money, the growth, and the initial investment tax-free. The other thing is just in case of emergency, if you want to pull out any money from that account, you are able to pull out any money that you initially invested without a penalty, but you cannot pull out the growth without a penalty. Important to know about a Roth IRA. Okay. So it can be that like emergency account just on the money that you invested. You really don't want to pull out that growth because you'll pay a penalty if you're under 59 and a half. So these are two really big ones. If you're just starting out, I want to pause here. If you're just starting out and you're like, hey, I'm not maxing out both of those things, because $10,000 a year, that's a sizable thing. Even if you don't want to get the HSA healthcare plan and put $6,000 in a Roth IRA, if you're married, you can contribute $12,000, right, for you and your spouse. So it's important to understand that just doing that, that's a great first step. If you're hungry though, and you're looking for more, that's where you kind of escalate into the next tier. And you have to ask yourself a question, especially as a small business owner, is do I have an employee, so a W-2, who has worked for me for more than a year? So they've worked over 1,000 hours. If the answer is yes, we're not going to talk about and dive into this too much. But if the answer is yes, you want to look up something called a simple IRA. So if you pay someone, it's a simple IRA. It's a different type of income deferment account. It's called a simple IRA. For most of you, though, the answer is no. You don't pay too many W-2s. If you do pay anyone, they're usually a contractor. And so, yes, simple IRA. If no, solo 401k or a Roth 401k. Essentially the same thing. It's a little terminology, and you can contribute up to $19,500. So again, this is another pretty big chunk. And you're going to see in the example that we show that what this does. And by the way, the catch up for over 50 is $6,000. So you can contribute up to 25.5. Now, if you're like, hey, I've already maxed out my solo 401k, I've got a Roth IRA. Well, the next step is called profit sharing. And this means that, first of all, if you are not incorporated versus incorporated is a big difference of what you can contribute to profit sharing. All right. So profit sharing, you can contribute, if you are incorporated, up to 25% of your salary. And again, I'm going to show you the example here of what's going on. Now, if you're not incorporated, you can contribute up to 19% of your profit. Now, high recommendation here. And again, this is just my recommendation. If you're not incorporated and you're thinking about profit sharing, first you should probably think about becoming incorporated. All right. Because that means you're making a decent amount of money where you've contributed to a Roth IRA, you've contributed to a solo 401k, and then all of a sudden you're like, hey, what do I contribute to next? And you're not incorporated. You may want to think twice about staying not incorporated, aka a sole proprietor. You may want to think about becoming incorporated, and that way you can do 25% of your salary. Okay. Again, I do want to reemphasize that this is just the way that we look at order of investing. You may talk to someone who sells life insurance. And by the way, my partner sells life insurance, and this is still our view on the order of investing. So I want everyone to understand the power of how we feel about this. Again, just a quick note on solo 401ks and profit sharing. A lot of them, if you do it right, can be done as income deferral. So you don't pay taxes on the way in, but there is taxes on the way out if you think you're going to be in a lower income bracket when you retire and you want that money out. Okay. So the next order of investing, this is kind of like where you can decide, hey, if I really want to go more on the retirement side, or do I want investments that can pay off more in the short term? This is where you'll probably talk to a financial advisor. In fact, you may start wanting to talk to a financial advisor right after you've started to fund your Roth IRA and you're starting to think about your solo 401k. Okay. And again, I can easily pass your information along to someone who can properly advise you on what to do. But the next step is permanent life insurance. And that's not the life insurance you see on TV where they're like, hey, it's $30 a month. This is permanent life insurance. Your money grows. It's not just a death benefit. Again, I'm not going to get super far into that. But what we tell our clients is get your eggs in it, or you get your ducks in a row first when it comes to Roth IRA. Take advantage of all these tax deferral programs or income deferral programs before you start attacking permanent life insurance. We do see people fall into permanent life insurance too early, or they fall into some other type of investment too early before they've kind of secured their future. And if they don't care about their future, then hey, maybe they are just looking to invest in the stock market and they shouldn't be on this call. But where to go? So let's just talk about if you're going to do an HSA or a Roth IRA, that's where we would tell you, hey, do it yourself is maybe okay. Okay. HSA, you can go to hsabank.com and set one of those up. You can also go to these different websites, Vanguard, Fidelity, Charles Schwab, Betterment. All of them, you can go and set up a Roth IRA. It's not hard. Okay. When it comes to advice, tips, assistance where to set up a SEP IRA, a Roth 401k, I'd highly recommend going and talking to a professional advisor like Merrill Lynch. I use the Next Level Planning Group. Granted, my partner happens to own the Next Level Planning Group, but it's definitely one of those things where you want to start talking to someone who can like officially assist you instead of trying to do some of that stuff on your own. So I mentioned a case study. So John's a sales professional. He and his wife have 2 kids. Joan's a full-time mom, so no income there. John is incorporated and takes a salary of 75 grand. Okay, keep in mind this terminology is very important. He pays himself on a probably monthly salary, and it adds up at the end of the year to 75 grand. On top of that, his business has an additional profit of 125 grand. So the way he would receive that is called an owner's distribution. So he'd get that as an owner's distribution. So total, his business profited 200 grand. He paid 75 of that as a salary. Okay. So on paper, his business technically profited 125, but he sees 200 of that. Okay. Why is this important? Okay. Because some of you are thinking, oh, well, he's over the income limit for a Roth IRA. However, keep in mind, if him and his wife both contribute to an HSA, they are now under the contribution limit because the HSA is pre-tax income. So he can move his 200K down to 193, and now he's under the Roth contribution limit for him and his wife. So he can contribute $6,000 and his wife can contribute $6,000. Hopefully everybody followed there. Okay. He also decides to max out his Roth 401k or his solo 401k at 19.5, and he decides to max out and do 18.75 of his salary. So keep in mind, he's investing a decent chunk here. Okay. The quick math is right around 50K. Okay. He's investing about 50K of that 200, but he's saving himself 15 grand in taxes. Okay. Because again, he's income deferral on that top profit sharing and solo 401k, right? So he's moving that away. At the same time, his HSA is enabling him to contribute to his Roth IRA. Granted, his solo 401k and profit sharing would allow him to do the same thing. But this is about a $15,000 this year in the year 2020 savings in taxes. So the very first step to all this is to spend less than you make. Okay. Now I know some of you may have some questions on what we just went over, and that's great. Got time at the end. But the very first step to doing any of what we just talked about is to spend less than you make, AKA growing the gap. All right. Growing the gap. I have a very interesting perspective on this because I think all of us at one point in time were 18 or 19 or 20 and we decided to live on our own. I want you to think back the first time you lived on your own. Your expenses weren't what they are now. I hope everybody can agree with me there. I can remember, I think I was paying $500 a month rent and I was trying to use under 500 more to pay the rest of my bills. Now, somewhere along the way, which is really a gradual process, my expenses started to grow. They grew to $1,500 a month, then $2,000. They grew to $2,500 and then $3,000 and $4,000 and so on. And what's funny is that they were probably directly correlative with my income. So as soon as I started to make more, I figured I could spend more. This is a big mistake when you get to a certain point in your life. Unfortunately, we have clients come to us in one of two ways. The first way is the great way. They start making more money and just want more control of their business. That's the great way. Unfortunately, the other way that people come to us is when they've started to spend more than they can really even figure out where the money is going. And then an income hit comes and just bad stuff starts to happen. Well, the very first step is just understanding that when you start to make more, that doesn't mean it should enable you to spend more. So once you feel like you are making an income that is livable for you right now, in the future, 50% of that budget should go to needs. This is a really important concept. So if you feel like you're overspending right now, I'm going to recommend an app for you in just a second. but look at where your cash flow goes. Let's say you bring in 10 grand a month. Are you spending 5 grand or less on groceries, your living situation, health insurance, and a car payment? Are you spending 50% or less on that? If the answer is no, you need some help in budgeting. Okay. If the answer is yes, the better question is, where is the other 50% going? Right? 30% once, right? Everyone enjoys dining out. We have hobbies, shopping. I love to go golfing, and I still can go golfing right now. It's actually kind of nice. I can kind of still eat out right now, but we all have different things that we enjoy spending money on. I always tell clients, I will never tell you how to spend your money, but I will show you where you're spending it. Okay. So 30% on wants, 20% to savings. Okay. That is like the 50, 30, 20 budgeting gold standard. If that's what's happening, great. You're in a good spot, and maybe you just hopped on because you wanted to hear where your savings should be going. All right. If this is not, you really got to take a look at where your money is going. So how to track that? I use Mint. The reason I use Mint, because I like the app on my phone. So I set it up on the computer, but I like being able to view stuff on my phone. It's also a free app. Why and how is it free? It's because Intuit owns it, which is the gold standard for accounting software. So Intuit owns it, and they want to sell you credit cards. So they look at your spending habits, and then they try to figure out how to sell you stuff. Okay. But at its base and core level, Mint is a phenomenal personal budgeting app. Okay. On your business side, you can use a company like us. Some of you on this call are on this call because you use us to track your business finances. We use QuickBooks Online. We track every single dollar and penny that goes in and out of your account. Okay. So again, going back to what I said to kick off this entire session, which is most sales professionals are great at selling. Not all of them are great at maintaining their business. They want to feel like a business owner, but they really just feel like a sales rep. That's where we come in. We want our clients to spend most of their energy and most of their time doing what they do best, which is selling, and let us handle the back end, send you reports, and we can have a call once in a while. That's what a service like us is there for. So I wanted to add this little tidbit because I know that some of you are thinking about your debt and how you can still build wealth while having debt. And it's common. It's a really common thing because credit cards are accessible, lines of credit are accessible. You have a house, you have a car. So let's talk about the different types of debt. 3 different categories here: 0 to 5% interest rates, 5 to 10, and over 10. And we're not even getting into compounding or simple interest. Let's just eliminate those words. Let's just say you look at your statement, it tells you what your interest rate is. Okay. If you have anything with a 10% or higher interest rate, you should not be thinking about saving right now. You should be paying off debt, and don't save until this debt is paid off. The reason why is simple, because when we get into this orange rate, the money's split 50-50 because the interest you will gain on an investment versus the interest you're paying on debt is they're about equal in that 5 to 10% range. However, when you're at the 10% or more interest rate on your debt, it's very hard to beat that on growth on an investment. So you can't beat it at a rate that's higher than what you're paying out on your debt. So you need to pay out that debt as soon as possible. Okay. On previous calls, we've talked about different strategies on how to pay off some of this high interest debt. Now, if you've got stuff at 0 to 5% interest, just pay it off as the schedule says and save the rest. Easy examples of this, especially nowadays, house and car, we will never recommend to a client, hey, just pay off your car early. First of all, car loans aren't compounding interest. They're simple interest, which means they were a couple $100 and it's spread out over however many months you did that car loan. So we'll never tell a client like, hey, pay off your car loan before you start your investment into a Roth IRA. We'll say, hey, pay the schedule that it tells you. Great. Same thing with a house. Again, very low interest rates. Okay. Now, I should have put a little asterisk on this because if you have a 0% interest credit card, keep in mind that, like, let's just give an example. Let's say I go buy $4,000 in furniture and I get one of those 0% interest plans, and they say it's 0% interest for let's just pick a round number, even though they don't do this. Let's just pick 20 months. Okay. However, when you get the bill, in your head, you're like, well, 4,000 divided by 20 means I should be paying $200 a month in order to pay it off. And you would be the smart person. Okay. However, they send you a bill and it says, hey, the minimum payment's $42. So what the casual consumer does is they pay that $42. And after 2 years, they go, oh, well, I thought my bed's paid off. And they say, no, that's just the minimum payment you need to make. Now we're going to charge you all the back interest on that $4,000. So the important thing is when you get into one of those 0% interest rates, whether it's a credit card or whether it's a like line of credit at a store, you have to remember to set up the automatic payment that pays your entire balance off before the 0% interest expires. I know it's a simple tip. Not everybody really realizes that, but on that 0% interest, there should be a little bit of a little asterisk to make sure you're not just paying the minimum, you're paying the schedule in order to pay it off in time. Okay. That this is a really, if you want to take a screenshot here, this is a good screenshot to take because it's just a good guideline, right? And it enables you to look at your interest rates. Same thing like student loans. We get asked about student loans all the time. Student loans most likely fall in the 5 to 10% interest rate. So you're not just paying the minimum, you're paying more. You're paying a little bit more, but you're also saving at the same time. Okay. Benjamin Franklin said, when all is said and done, more is said than done. I feel like this should be the end to a lot of presentations. And that's because there's always a lot of information and content in presentations, but sometimes the takeaway is not as or is a far less than the actual action taken because of the information. So whatever you take away, put down on take 15 minutes after we're done and put together a strategy where you're going to take some action on your situation that enables you to invest and get started in investing, invest at a higher level where you can use this information in a wise way. So I appreciate everybody being on the call with that said. And my gift to you is I'm going to give you two things. First of all, if you want to know about more of these Zoom calls or you want today's slide deck, email me. You can send me an email right now, Robert@MyBooks.PRO. So you can do that right now. And I'm giving away 5 free strategy sessions. So basically my booking website, as soon as the 5 free are done, then it'll start charging you $197. So if you want to book a one-on-one 45-minute strategy session with me, go to calendly.com/MyBooksPro. Super easy, super simple, calendly.com/MyBooksPro. And we can get very specific about your situation. All right. And with that said, I will open it up to some questions and answers. It looks like we got about 10, 15 minutes of some solid time. So I'll open it up right now.
Hey, Robert, I have a question.
Sure.
So I just wanted clarification, I guess, when you're talking about the owner's distribution and then also paying into just the different, the HSA and then the 401ks. For that example, was that person that you use as an example, were they using the 75K salary to pay for that, or are they using the owner's distribution? Does not really matter.
Okay, so let's just let's clarify one quick thing. We get asked this all the time. Okay, so when you become incorporated and it's just you, whatever your business profits, that's yours. You can't keep it in the business account and like hide money. Like it doesn't matter if you use the 125 of the profit / distribution or the 75K to fund any of these. Now, most of the time for cleanliness purposes, for like keeping things clean, whoever your financial advisor is or the financial institution, they'll recommend it comes from a certain account, but it's not the end of the world if it comes from the personal or the business, or if it comes from your salary portion or your profit portion. Does that answer the question?
Yeah, I guess one follow-up question I have to that, because I'm just a little confused on the tax purposes part, because I know obviously the salary is taxed, and then you were kind of mentioning how the owner's distribution wouldn't be taxed, but how does someone get around? I feel like that would be like a weird loophole that the government wouldn't allow.
Yeah, so I guess you bring up a good point where the salary is technically already taxed. Now we're talking about different tax here. We're talking about um, payroll taxes on a salary, whereas when you get to avoid paying taxes on income, we're talking about income tax. So
Okay.
just two different taxes. So you could technically use any of that money, and it would come off of your taxable income, right? So when you get that, let's say that we'll go back to that example where this person is contributing. Give me 1 second here. We'll go back to this example where this person is contributing 19.5 from this solo 401k. That solo 401k essentially means that they would pay taxes on 180 grand instead of 200, because the 75 and the 125
Got it.
combined,
Yeah.
that's all
Okay.
I mean. It's tax deferment. So basically he's taking that 19.5 and saying, hey, I think I'll be in a lower tax bracket when I decide to take my disbursement later on. And so he's
So then
not
it would,
paying taxes on it right now.
okay. And then I guess my last question then, so it'd be, since I'm in Nevada with no income tax, it'd be more beneficial to, if I want to invest in these pre-tax for, just investments to take that on my payroll, then would that be correct?
You can do it through your payroll. Now, just because you don't pay state income tax, you still pay federal income tax. So
Right.
again, it deducts off of that federal income tax.
Okay. Gotcha. Okay.
Yeah.
Cool. Thanks.
Solid in-depth questions. I appreciate that. Ryan, it looked like you unmuted. Do you have a question?
Yeah. So prior to this call, I had never heard of profit sharing plans before. So
Mm.
this is a whole new path that I'll have to dive deep into. But my just one quick question is, for a company with employees, is there any tax benefit to the company by creating or implementing a profit sharing plan for the employees,
Yeah.
or is it all after tax dollars that money's paid with?
Yeah, so that's why I mentioned the simple IRA, where if the company has W-2 employees, the simple IRA can be, and this is a whole rabbit hole, right? But the simple IRA can be done in two different ways. And one of them is, they're both tax benefit. They both benefit you on the tax front. It's just one is a little bit more depending on how aggressive the employees are about contributing to their own. Because when you have employees, there's matching. So you have to match the employer has to match the employee's contribution. And when you go down that rabbit hole, the two different ways you can do it is really about, like, do I want to gamble on the fact that they won't like put in a lot, or should I just put a set amount? Essentially, that's what the gamble is. But
Yeah,
it
we
is,
have a 401k plan, and we put in whatever their salary, their compensation is. We contribute 3%, even if they don't
oh, so you do,
contribute anything. We do 3% all the time. So
so
could
you
we
don't,
have a profit
they
sharing
don't
plan
gamble.
in addition to a
Yeah.
401k plan?
Say that again.
Could my company, could we implement a profit sharing plan for the employees in addition to the
Yes.
401k plan that we already have in place?
Yes. The caveat there is the profit sharing is is all based on your percentage, what the employee can profit share as well.
Hmm.
So if you profit share 25%, the employee can profit share 25% of their income. It's the percentage, not the volume.
Got it.
Yeah. But yeah, it's definitely something that I would look into depending on how many employees you have and how much they're making. That's the big thing here, right? Like we're using an example of a guy that makes 200 grand and only has at most, with our example, 150 grand in expenses, right? On the personal side. So he's able to contribute 50K. Sometimes when companies have employees, but they're only paying them 25 grand a year, for that person to contribute 25% of their salary, that's kind of hard, right? Like that's the kind of thing to take into account there. So it's usually more beneficial for the business owner is the easy answer, depending on how much the employees make. Another good question. But whoever runs your 401k, I would inquire with them about your profit sharing. Cool. Anybody else have any questions on the stuff that's on my screen or anything else we talked about? I see a few more people popped on the call. I'll jog everyone's memory or brains a little bit in that we're finding more and more, like every phone call that I have throughout the day these last couple months, more and more people are looking at what they spend money on, and they're just deciding, do I need to be spending money on this? What value am I really getting? Or they look at it right away and go, what? I'm still paying for that? So if you haven't done so, I'd really just encourage you to be very introspective with your personal and professional finances right now, because the time is now more than ever, especially with all this, like, people call it free money, like these stimulus checks or the PPP loans or the EIDL grants, all these different things that are coming. Like, money should be on the forefront of your mind. So take a good look in where you're spending money, where it's going. Is it useful? Should you cancel it? And I know sometimes it's like $10 a month and you're like, oh, it's $10 a month. Well, $10 a month is $120 a year. And if you have 8 of those, that's $1,000. So just keep that in mind. Anything else? Good. All right. Well, hey, I thank everybody for being on. Hopefully I'll chat with all of you in the near future. And yeah, feel free to email me with any questions. If you want a copy of the slide deck, that's great. I'm going to end up putting this Zoom call on YouTube just because Facebook Live wasn't working. But I definitely appreciate everybody's time and wish you a good rest of your week.